Welcome back to the LPR Trading Group YouTube channel. It's Dave again. I've got another video for you guys today. It's been a while since a video, but we're back at it. Today we're going to start talking about risk management. I had a few requests here on risk management videos. It's not something I've touched on recently on our channel, so I'm going to go ahead and do so. All right, with risk management, there's a few different categories here. Number one, we're going to start with trade types. Now, you might just trade one type of these trades, right? As an intraday day trader, you might be a scalper. You might trade off areas of interest, so you're getting like, let's say, an on-session low to an open price type trade. Maybe you're getting a 10, 15 point move, 20 point move on ES. Then there's intraday trend type trades where you're looking at the market, you're anticipating a market continuation to the upside, to the downside, a bounce, an all-day rally, an all-day fade. So these are typically trades you're looking to get into and hold until the close. Now, with these types of trades, there's going to be different risk parameters for each trade. A scalp trade, I like to think of like this. A scalp is right or right out. Okay, if you want a scalp trade, you're typically looking for a few points in the market. I do not like to hold these trades for 5, 6, 7, 8, 9, 10 point stops. I just want to be right on the trade based on what the order flow in the book is telling me. And then once I'm right on the trade, I want to be right out for 3, 4, 5, 6 points, right? So these are right or right out trades. I take my stop on these trades. I cut the trades really quickly for a loss. I try and scalp off the entries and I scalp off the stops. Intraday or area of interest trades. These are trades where I have a bigger picture idea. Okay, I'm looking at an on-session high, an on-session low, a low volume node, a high volume node, possibly ledges, something on the footprint, or something on the TPO chart. Price gets into that area. I wait for a reaction in price. We analyze the order flow as it runs through the market. We take a trade, and then we're typically risking 4, 5, 6 points to start on this trade. Now with these types of trade, an area of interest trade, I like to take what's called a feeler. I like to get in for 20, 25% of my position within that area. Once the trade starts working in my direction, then we can look to get bigger on the trade as it gives us more entries. Now, the way these area of interest type trades could work out is it could start as an area of interest trade. For example, we could be getting long or short off a reaction on a low volume node on our profile, and then once the trade starts working out, we can add scalps to the trade. Now what does this look like? Okay, so if we have our volume profile here and we have this low volume node that we're looking at, okay, price comes down into the low volume node, we're holding, maybe we trap below, we start driving to the upside, we get a long somewhere in here for a starter. As we start pulling back, we can possibly add more into the position. It starts working in our favor, and we can start adding scalps to this trade as it's going to the upside. Maybe our target is high of day on a trade like this. So I'll look to get bigger and leverage the position as we start driving to the upside. If we look at intraday trend type trades, depending on what the market is doing and how we're analyzing the market, the way I typically trade these is if the market is in a balanced range, okay, the profile is telling us we're in a balanced range, most of the volume is being done in this area for maybe the past week, and price is kind of chopping in this range just like this. When we break out of the range, if we can confirm that price is holding outside of the range and buyers are going to accept price higher in this area, I like to get long and hold this trade for a nice explosive trend, squeezing the shorts out that were short in this range that try to short this pop, as well as taking advantage of everyone trying to get long up here and just riding this trade out. How does the risk work on these types of trades? It's going to be a slightly bigger stop as well. Maybe the stop on this trade to start is going to be 5 or 6 points as opposed to like my scalp right or right out trade, which is like 2, 2.5 points. Okay. Now we come down to account size versus risk amount. Now, there's a lot of evaluation accounts going on right now with all these funded brokers. I see a lot of people trading the $50,000 accounts, 50K account. Typically this account right here, you have a drawdown of $2,500. And on some of the funded prop firm companies here, there's actually a trailing drawdown of $2,500, okay? And I see people risking $500 or $1,000 per trade. Essentially, they're just trying to trade too big, and they're going to blow up a lot of these accounts before they actually get one funded. And then if they do get one funded, because of their bad habits, they're likely going to blow that one up at some point as well. What I would recommend with these evaluation accounts, if you want to trade them a little bit more aggressively, trade with $200 to $300 risk per trade. This is very aggressive, okay? $200 to $300 risk per trade. You're looking to make maybe, $400, $500, $600, $700 per win on risk like this, maybe $800, $900 per win on risk like this. That's going to grow the account just fine. You'll be able to get funded. It'll be a little bit more controlled than risking $500 or $1,000. That to me would be aggressive. If you want to trade these more conservatively, trade the micros. Just trade micros and risk like $20 to $50 per trade. The idea of the trading world is survivability. The longer you survive, the more you learn. The more you learn, the better you're going to be. If you're just constantly blowing up accounts, you're never going to learn. And on a side note, this is not a journaling video here, but if you're not journaling, you're not going to be able to really identify what your risk parameters should be on a given trade. Your scalp trade, you might be risking 1 point, 1.5 points. You might be risking 4. I find my sweet spot is 2, 2.5 points. These are things you'll find out by journaling your trades and going through your entries, exits, trades, and strategies. Okay, once we get to the funded accounts, I highly recommend if you get a funded account and you pay that initiation fee for the funded account of, on most platforms, about $140 to $200. You pay this fee, now you're funded, you're back to your $2,500 drawdown. We're just talking about the 50K accounts here. You don't want to go and pay this, then lose this, then have to start back at the eval. Take this account, trade it even lighter. If you want to trade these accounts heavy, I recommend $100 worth of risk per trade. Grow this slowly and organically. Once you grow this slowly to have a $10,000 buffer, so that means you turned your 50K account to 60K. Your trailing drawdown would come up to $50,100. You have a $9,900 buffer. You can start treating this like a $10,000 account, cash account, okay? You want to keep this account, you want to grow it, you want to trade it properly, and you do not want to lose it, okay? If you're trading a cash account, the risk is obviously going to depend on what size your account is. But if we just go by simple percents, I would say if you're very passive, you're risking about 0.5% a trade. If you're more aggressive, you're risking about 2% a trade. Figure out what type of person you are, what type of trading strategy or style you like, and where your risk parameters fall in. I would say do not risk more than 2% of your account on any given trade. It's just not worth it. One trade is not worth, detonating 5-10% of your account. It doesn't matter if it's a good trade, bad trade, whatever it is. Just stick to no more than 2%. Now we go down to risk tolerance. This is going to be different for a lot of people. How much risk can you mentally tolerate? Now, if you come into the markets and you're on a $50,000 account like we talked about before, and you risk $500 on a trade and you lose, and once you lose that trade, you look at your P&L, or your P&L looks at you and it's staring you straight in the face, and you cannot stomach the fact that it is minus $500, that means this risk allotment is too big for you, okay? If you're in a trade and you're risking $500 and your goal on the trade or your target on the trade is to make $1,200 to $1,500, because that's from your entry to your systematic target that you know or think the market should go to, is going to yield you that return, and the market starts going up and you are up $750, and you find yourself cutting the trade here for no reason because you're green $750, you are risking too much. You need to size back your position. Okay, sure, the $750 feels good when you take it, but when the market goes like this and it goes to your $1,500, you definitely should have just followed the plan and let the market do what it had to do. The reason why you took the $750 is because you're risking too much to begin with. So you should size back until you can follow the plan of, I'm in the trade, this is my stop, this is my target, I'm not touching my position, I'm letting it do what it has to do, because I'm making this entry, this stop, and this target based on previous back testing. I hope your journal, I hope, and mistakes you've made in the past, right? What sort of P&L swings can you tolerate? Here's another thing. If you enter a trade here and you're risking $500 per trade, okay, $500 per trade, your stop is down here and your target is up here at the $2,000 mark. If the market moves up $500, are you thinking in your head, I don't want to give back $500. I have to sweep my stop to break even right away. And then we come back and it stops you at break even just to go to your $2,000 target. You're not able to tolerate the swings of up $500, back to break even, etc., etc. Size down, okay? I don't want to go to this crappy analogy, but like the turtle wins the race, right? Does it really? I mean, I don't know. But here, the turtle wins the race. Trade small and just let this play out very slowly and very steady. What's going to happen is you're going to be a donkey and you're going to full port all of your evaluation accounts. And 1 year of time is going to pass. Okay, 1 year of time is going to pass. And where are you going to be? Where are you going to be? You're still going to be full porting evaluation accounts and just rebuying them on 80-90% discounts. All right? Instead of doing that, why not just get one account, take 1 year or 6 months, and trade this account properly? At the end of 1 year, you probably would have accumulated a good handful of funded accounts very slowly, very surely. This 1 year is going to pass. You can either use that time and do it right, or you can be a donkey and full port these accounts and be like the 90% of other people who are just constantly full porting these accounts for the big win. You're not going to get there doing it that way. Do it properly, okay? Rules. Some rules you should have in risk management. Number of losers before you shut it down. Typically for me, if I take 3 losers in a row, I just kill the charts for the day. Okay, I just kill the charts for the day. I should not be trading. I'm not seeing the market properly. That's it, right? I'm just done for the day. Trading times. This is very important. A lot of people will go, well, they'll have a target on the day. Okay, I want to make $1,000 today and I'm done trading. Now, this is okay for some people. For me, it doesn't work. I know that I trade well from 9:30, which is market open, to 11 a.m. This is when I trade well, okay? So if my target was $1,000 and I made $1,000 by 10 o'clock, I feel like I'm cutting myself short seeing the market very well because my journal is telling me I still have an advantage in this marketplace for another hour till 11 o'clock. So what do? If I've hit this $1,000 target at 10 a.m., I continue trading. I take one more trade until I have a loser. So for example, if I take another trade at 10:15 and it's a winner, and now I'm up 2,500, I continue trading. I take one more trade. If I lose that trade, maybe the next trade I take at 10:30, if I lose that trade, then I'm done. I've hit target. I've given myself a chance to play strength to strength and really accelerate the P&L on the day because I was doing well and still within my trading time. But I've also managed myself saying if I take one more loser after that target, I want to be done. And then I just shut it down. I take a loser, I shut it down, that's it. My best days statistically, I've always had a loser as my last trade. Why? 9:30 comes and I trade 9:30 to 11. If I have 2 trades from 9:30 to 10 o'clock and we're up just random numbers, $2,000, and I take a third trade and we make another $1,500. If my target on the day was 2,000, we're up 3,500 now. Then I take another trade and we're up 4,500. And it's only 10:30. Then I take another trade. 6,000. 10:45, I take another trade. 5,500. Okay? And we end the day on the loser. You see how my target was 2,000, and because I kept playing strength to strength with rules, if you lose a trade, you're done. You trade from 9:30 to 11. You only trade your setups. You abide by your risk, and when you take that loser, you got to cut it off and kill it. That's it. You're done. We just added another $3,500 to the P&L, the hypothetical P&L here. Okay? This is maybe a rule you guys can apply in your trading, which is fantastic. If it works for you, I'm super happy. Continue to use it. Leveraging your trades. This is very important. I started doing this a few years ago. It's difficult to do, but it's going to pay if you learn how to do it. What is leveraging your trades? Let's just say the market is coming down. It gets to a key area or an area of interest. We're interested in buying somewhere in this area. The market forms some sort of structure in this area. We analyze price action. We break to the upside. Market pulls back. We're looking to buy. Great. I buy. Maybe I buy 25% of the position, 50% of the position. I buy. The market drives to the upside. We start driving to the upside. Instead of taking a partial here at what might be first target, let the market continue and look for adds to get bigger on the trade. Continue adding to the trade. And as you're adding to your trade on pullbacks in value, you're looking to get bigger and run this market as far as you possibly can, or to a major target you might have. This is leveraging a good position, adding to the position, and now you're able to sweep your stops up every ad almost, if not over, break even. But your stops are still in a very good spot. So work on leveraging your trades and leveraging yourself up. If you can do this, this is going to prove to be very fundamental skill in your risk management. Okay, why? Because when you initially get into the trade, you're in small, and as the trade is working in your favor, you're getting bigger, right? But you got in small initially, risked a little bit, and every ad is almost a free trade. I hope you guys enjoyed this video. As always, like, comment, subscribe. If you guys have any questions or comments, leave them down below. I will get back to every single comment down in the comments section. Hope you guys enjoyed this video. Trade safe on the charts. Cheers.